Hey, welcome everybody to the market outlook for third quarter. This is QuantZombie, so I'm the chief analyst for QuantZombie. It's my ministry. So at the moment here, I'm an ex-analyst. I'm also joined by Joshua Tan, who's also the ex-head of research for Philips Securities. He's going to give us his take on the macro strategy going forward. So just for those who don't know what I'm doing, everyone on the team are basically ex-professionals, and we're pretty good at our jobs. And at the moment, this is just a ministry. In other words, we're not charging for our services. We're trying to give guidance to people for free. We sow into you, and we hope that you will just sow into us in our future ministries. Okay, so that being said, let's talk about what we have for the third quarter going on. Just for the sake of people that don't know who we are, just some quick words about us. Okay, so both Joshua and I, we're both professional ex-analysts. Joshua specializes in stock picking and macro strategy. For myself, I was a stock picker as well as a market analyst. So we often work together to provide market guidance. And this is just a write-up on us in 2014, all the way back then. So yes, many years later, we are still at it. Okay. Here's an example of my stock picking, where I got myself on the map by doing Valuetronics. I was one of the first few people to cover Valuetronics back in 2014. And I suppose I got myself on the map when basically, if you look at my target prices, which are in red. So here's where I did analyze the company on the fundamental level. And it so happened that I nailed the target price for Valuetronics exactly 3 times in a row, which is basically quite, let's just say it made a lot of people raise their eyebrows how it could nail the price so exactly. So that's how my journey started. From covering individual companies, I will also give market outlooks as well on the US market. So in 2015, here's, by the way, these reports that I'm showing you, right, are all public material. You can actually probably still Google and find them. So whatever I show here, you can easily verify it for yourself. So yes, in the US market, 2015, right? I've really given guidance, and I've been paying attention to the market ever since. Just FYI, over here I did what we call an Elliott Wave count, and just by looking at the Elliott Wave count here, what I am implying is that this move is only halfway done. And so the reason why I show this is because fast forward 7 years later, right? This was true, that we are halfway done. We've made to the other half. So the question is like, okay, what are we going to say about this major bull market? Is it over soon? Is it over now? Okay, that's the question we're going to answer today. I also managed to do some work in quantitative analysis as well. So for myself, I come from a different perspective. I come from a perspective where I did fundamental analysis, technical analysis, and some quant. And that's why I feel that my view is a bit different from what you see out there. I came back to do this ministry in 2020 when COVID came. So I was pretty silent until the COVID crash occurred. And then when the crash had gone over, what I felt was oversold, and I saw many people panicking and not knowing what to do, that's when I re-emerged. And for the first time in months, I basically came out and wrote about the market here. And so for months, I didn't write anything. And then once you got to here, that's when I said, by the way, my expertise is in finding out where the bottoms are before the bottoms actually occur. This has always been an obsession of mine. It's very easy to call a bottom once the bottom has occurred. It's very difficult to call a bottom when you can't really see it yet. And so that became like an obsession of mine. And for me, I developed my own heuristic of sort of like how to find the bottoms, because finding bottoms goes a lot deeper than technical analysis or even fundamental. So that's why I say my core competency is. So I practice that core competency here. While Goldman Sachs was still very bearish, and they wrote that it could be another 20% down move, I mentioned that nope, I don't think so. I think that companies have crashed so much that the intermediate bottom might be in place. By intermediate bottom, I'm really meaning a bottom that can last weeks. So even if it's short-lived, right? If it lasts weeks, you can still gain a lot from there. And so I basically said the risk reward is very high, you should accumulate here. And then just to sort of like flex that I know some technical analysis, after this big move over here, before the collapse down, I already mentioned that we should take profits on those that surged and bought laggards. So in other words, if you did that right, your performance would be very, very outsized. Between 2016 and 2017, I actually had the privilege of advising and managing an actual professional fund. And so here is my actual public performance. As you can see, from 2016 to 2017, while the benchmark of STI was only 20% higher, my fund actually got 66% higher, and I did it with zero leverage. In fact, if you look at here, you can see how much cash to equities I held at any one time. So I was actually being very conservative. So this big move here, how did I outperform? It is solely based on stock picking and superior market timing. It's just these two things that's what contributed to my alpha. And those are the two things that I'm actually trying to teach people about how people can be their own fund managers by stock picking and doing good market timing. So, but that's another story. So that's my performance over here. You can easily verify my performance because in 2016 to 2017, I decided to keep my trades transparent. And so if you go to my website, QuantZombie.com, under blog, you will see all my blog posts, and you can actually see even all the posts that I did during that time, 2017, 2016. I actually posted my thoughts and some of the trades even as I took them. So you can actually see, and I encourage people to come along the trades with me. So you can actually see for yourself how I managed to get that performance. So if you haven't seen my blog, I suggest you go onto my QuantZombie website, subscribe to the mailing list, and you can see my blog posts, and they are free at the moment. Remember, I said it's a ministry. Okay, so if you're gonna keep up with me, go to the QuantZombie.com page, join the mailing list. If you haven't already, join the Financial Markets and Godly Wisdom Fellowship Facebook group. That's where I put my updates. Okay. And there's also a QuantZombie.com Facebook page. I suggest just joining all three of them. So I don't give guidance often, but when I do, it's often, I will say I'll only put it out when it's important. Okay, so let's start officially. So market outlook, will there be a bear market rally? Actually, the reason why I mentioned this is because I started preparing this presentation 4 days ago. So in 4 days ago, right, we didn't quite have a rally yet, but in the last 2 days, we had a rally. So the thing is, well, some of the analysis is like 2 days late. But hey, some of the factors are going to be still relevant. Okay, so let's talk about 6 things today. First of all, I just want to recap how we even got here in the first place, starting from the beginning of the year. Okay, so 1, 2, 3 will be how we got here and some of the calls. We're going to recap all the calls I did for the first half of the year. Then we're going to measure this bounce. Then Joshua is going to grace us by talking about the macro. Then we follow up with some stock ideas you will want to consider going into an uncertain second half. Okay. All right. So how do we get here? So just recall, okay, so here is 2022, okay, right? And so we know from hindsight, it's been generally bearish and it's been, has big swings, but generally bearish, right? But in the beginning of the year, our guidance was here. And these were all the main points that we talked about in this market outlook in the beginning of the year. This was free. You can go back to the webpage, our webpage, and check it out. Why we had our thoughts. And we said that the first half of the year was going to be weak and whippy, which is what it was. We didn't expect it to be this weak, but at least we were correct that it was more bearish than bullish and it will be whippy. We mentioned the second half of the year should be better than the first half of the year. We already mentioned to keep 30% cash to play the drops, which if you did that, you're probably going to outperform the market. We said to overweight value and defensive stocks all the way here. If you did that, you will massively outperform the market. And we even gave a few stock recommendations, and our top picks were ET and VST that were value and defensive stocks. Okay, so that was what we started off here. So let's do a quick recap about. So this is what we had in the 10th of January. Okay, so I just want to do a quick recap. We said that first half will be treacherous. We said the energy sector will be buoyed by high oil prices, right? We said there will still be demand for data centers and metaverse, etc. Okay, but we said that value is going to do well, defensive is going to do well. So I concluded with some defensive value stocks. Okay, and to keep cash for dips and overweight defensive value. So that's the main point that we've given. So we just threw out some recommendations out there. Okay, and this was the exact slide that we had on the 10th of January. So we basically talked about some defensive value will be up here. these three stocks for defensive value. This is the one we chose for energy sector, right? This is Micron and Intel was for basically secular chip tailwinds, and we had some value snapback and deep value snapbacks for diversification purposes, right? Then we also mentioned if you really have to speculate, if you really want to go into growth stocks, right? We mentioned maybe these three are worth looking at, not your typical ones like Palantir and all that. We thought those were really overvalued. Okay, so based on these things here, I took the liberty to just show you the performance back then. Okay, so let's go through from the 1st of January, okay, to most recently here and 1 week ago. Okay, so the S&P and so we use these three as benchmarks. All right, we have the S&P as the first benchmark, the semiconductor index second benchmark, and so this is innovation fund, not innovation fund ARC as the third benchmark. So we know that since 1st of January to now, okay, to now, we see that the S&P at its lowest, it dropped by 20%, but as of last week, it was down 13%. SOX, or the semiconductor index, was down 30%, but now it's down 23%. The ARC, which is basically your innovation growth ETF, is down 60%, now down 55%, right? So this is the benchmarks. Basically, this is super bearish, right? This is really quite bearish. But if you look at ET and VST, and so these are the stocks that we mentioned that were non-speculative. From January to now, ET massively outperformed, 46% up, VST 16% up, SU 60% up. The chips are the ones that basically performed slightly better than the benchmark. So Micron was basically similar to the SOX benchmark, but Intel outperformed. When I say outperform, I mean it went down with the index, but it went down by less. And that's what I promised, right? In the beginning of the year, what I said was, these stocks, I believe, will outperform the averages. I didn't tell you exactly how much you're going to get, but I say it will outperform. And it has massively outperformed. Okay, so looking at the speculative ones, it wasn't that bad. Only UHIC performed exactly to the speculative benchmark, which is minus 60, minus 50. For AUD, actually, we have dropped by 30%. But actually at its high, it was up by almost 40%. So that's really not that bad. And finally, for Tellurian, right, this stock is up by 43%, but at its high, it was actually up by more than 100%. So actually, in general, we've done pretty well. If we just look at the investment benchmark, so these are speculative, and this is why I said for investors, you probably want to look at this. If you just took a simple average of every stock, assuming you averaged every stock here, you would have basically gotten an upside of 12% now, right? Versus the S&P, which is down 13%. So our outperformance is actually 25%. So in that sense, our take positioning ourselves to defensive value and having some cash to play the dips, right? You would have heavily outperformed most people out there. So we're really thankful for that, that God put us on the correct side of what's going on. Okay, so let's continue here. All right, so how we got here, all right. Then I also mentioned this. So even though we mentioned in the first half of the year that, okay, we said it's going to be weak and whippy, but I'm always on the lookout, right, for massively oversold regions because I don't want people to get whipsawed. So right over here, January 25th, right as this was negative, right? Okay, we mentioned already a relief rally is due right here. So we didn't publish anything, during this drop here. And sure enough, this was a short-term rally that you had a nice 8% gain from the rally. Okay, the next time we posted again was here, right over here. And we basically said that if there isn't any form of reversal today, meaning I expect the reversal today. Today it was important to wait to see if there's a reversal. I told people not to panic over here. Even though I know there were many market analysts that were bearish, I said, no, it could be another short-term bounce. Okay, finally over here, we said that ideally you get your upside reversal this week. So the thing is, right, as I told you, it's an obsession for me to find bottoms before they happen. So this was published on the day that it was a very bearish candle here. So actually a lot inside of me was making me feel to not publish anything, right? But I felt that I just have to be honest with my analysis. And the thing is, when I look at, I just want y'all to know that when I publish these things, it's based on a probability. So it means that I could be wrong. Okay, I could be wrong. It's just that I feel the probability of a bounce is very high. Okay, but honestly, the last 10 times I called for a bottom, right, I was correct. The thing is, every time I call for a bottom, I'm thinking to myself, this is the time I'm going to be wrong. But for some reason, it's still correct. Okay, but I have no illusions that I will be wrong eventually. Okay, so but I called the last 10 correctly. So this was correct, this is correct, this is correct. Now, why was this important? Because the next time there was an obvious bottom, oops, here, right? So like, for example, if you look at this, this looks like the same type of bottom. However, here's why I differentiate myself as a market analyst, because I go much deeper in the technical analysis. If you were an average technical analysis, you would say this is a bottom as well, because on support. However, in the consolidation, I actually study other things. And I determined over here that even though finally we hit something that looks like a bottom, I said that there is possibility for further downside. I said that, okay? And what's really interesting is I said this, okay? I said that the odds of bouncing out is 40% and downwards is 60%. So actually this time around, I actually gave the probability to the downside. And then I even mentioned the odds of further downside to 3,700 to 1,900 is 60%. For those of you who have been following the markets, right, look at where the bounce was. The zone was between 37 and 39. In fact, it briefly got into it before it came on. All right, so, and of course, finally, oops, not this one. Oh, sorry. So let me just get through this. I got too many slides here, sorry. I want to get to here. So here's where we are now. And so if you recall, if you've been following my blog post, and that's why I tell you, please follow my blog post. You're not going to get blogs often, trust me. Maybe I only write one once a week, once in 2 weeks sometimes, right? But when I do, I tell you important things. So on the 17th of May, which was somewhere here, I mentioned, hey, guys, it finally hit the nibble zone of 3,900. So basically, I tell people, I outline two specific accumulation zones. 37 to 39 is the first accumulation zone. The second one will be here, 3,450 and 3,500. I mentioned that I mentioned some reasons. I can't mention all my reasons because I look into a lot of things, but I just give you the main reasons. Because the macro wasn't broken yet, and I felt that what I've been seeing, looking at sentiment, looking at who's been buying in the market, etc., that I felt the market was attempting to find an intermediate bottom here. And then I finally gave the illustration that what's happening here is that it's kind of like poker. The way the markets are reacting is in such a way that the probability of a bounce is so high that is sort of like playing Texas Hold'em. And imagine if you were dealt ace and king. Now, just because you were dealt ace and king, it's not the best hand, but it's a hand that you must play. Even if you eventually lose the hand, you still have to play it. So that's how I likened it over here. And that's where we are at right now. Okay, so let me just pull you back a little bit to then remind you what we talked about in March. Okay, March is when we did this market outlook called Will We Go into a Bear Market Because Russia? And we gave reasons why we felt that even though, so these are 6 points that we talked about, right? These are the 6 points that usually precede every US recession. And we showed that even though we are very close to hitting all 6, we were not at all 6 yet. And so that gave me a probability that I don't think that we're in a bear market yet. Like if you want to give me odds, it's more like 60-40 that we're not in a recession yet. But at the same time, we are actually, the indicators are close enough such that if you do get a recession, I'll be surprised, but I won't be shocked, if that makes sense. So the recap is that back then, we said that there was no rise in federal funds rate yet. We didn't quite have an inverted yield curve. It was flattening, but not inverted. Unemployment was still doing really well. The only thing we really had was increasing oil prices and inflation. And you had the beginnings of some falling unit profits for some US companies. Okay, and the confidence ratio was starting to turn. But usually, right, you need all six before you have a recession, and we didn't have all six yet. Okay, so that's the reason why we said that there's a chance that we're not in a recession. We talked about how I gave the Elliott Wave count, my own Elliott Wave count, which is not easy to find because not many people comment on the Elliott Wave count for the S&P based on the super major bull market. And I basically said that this was the most likely. If you want to understand how I do Elliott Wave, right? You would have to attend my technical analysis class where I go into basic and advanced stuff. And I find it's useful for any investor that wants to know major market cycles. Okay, the stuff I do it's not really meant for day trading because I don't really day trade anymore. I just do it in terms of I want to be an investor and I want to get into the big moves that will last weeks and months. Okay, so doing the Elliott Wave count, I said that this is the most likely configuration. Most likely based on what we saw back then. This is corroborated by the 6 indicators that I showed you. Because an Elliott Wave count tells you that this is the most natural configuration, meaning that this drop down now that we had, remember this was done in March, right? That is likely to go down to around here and bounce out. And by the way, this is the exact slide that I used. And the reason why I show you this exact slide is I want you to note this. Look at where I put my down arrow here. It's at the 1900 and 500 mark. Very accurate. So in terms of the most natural configuration, this is where it wants to go. Okay, I'm not saying it will go there because Elliott Wave principle, right, is subjective and there's a lot of study that goes into it. So I'm not saying that this is the Bible and this is gospel. I'm just saying that this was the natural, most likely pattern if nothing extraordinary occurs. So if nothing extraordinary occurs, if we don't go into a super shock recession, right, this is where the market wants to go. Okay, so I said this is a possibility over here. You can get a major correction, but you're not in a bear market. However, Elliott Wave, right, does allow for other configurations. So this is also another possible configuration, but it is not as likely. I just want to tell you that. So it's possible to have your final wave 5 here to be the end of the bull market, and you really get your bear market. But this is not the most natural pattern. Let me just express it that way. So in other words, this should be sort of like the default that you're thinking about, unless you're proven wrong. Okay, so this is the one where the odds are that this is possible. So this is not impossible. Let me just say that. If you were down here, I will say this. If you were down here, I will say, yeah, it's very obvious it's going to go up some more. But you actually reach a point that you're sort of like almost at the end. So I can sort of forgive it if it goes into this pattern. Okay, so this is still possible. So which one is it, right? Is it going to be this one? Right, okay. So let's just go further. Now, so back in March, right, we actually gave some probabilities of certain scenarios. There's scenario 1, which, so this is back in March. So this is the slide in March, okay, where basically we said that the price goes up here, okay, and then right now we're here, and we already mentioned a couple of scenarios. Scenario 1, where it consolidates and then it goes to new highs, we gave it a 35% chance, or it starts to go down, consolidate here, and then recover, 45% chance, or we come here, recover, but actually you're actually further down because we're in a bear market. So at that time, we gave it 20%. Oh, by the way, these probabilities were updated on the 6th of May. Okay, just to FYI you. That means when the price was about here, we updated it to say that, okay, because by this time, the price had consolidated here, and I need to see the consolidation so that it gives me a zone that I can actually study into the market again. And I found that this bottom that was forming here was not as strong as this one, and this one. That's why I felt that, okay, the odds are it's going lower, and that's what happened. But even back here, we already said this, right? To have some cash handy, okay? And these were some stocks that we discussed about that time, that even though the markets can be sold off because some stocks are really expensive, but ET and VST have their own stories going for it, and they might still go up even when the market goes down. And that's what actually happened. But we also said, but if you guys are really, you don't want to risk anything, you can just stay out. If you're conservative, just stay out, see how it goes. And if you did that, you're also pretty well off. Okay, so now what's going on now, right? Okay, so now the scenario, which scenario is going to happen, 2 or 3, right? I'll put a question mark for now, because honestly, right now is and Joshua is going to go into it. Who's going to do the macro? He's going to show that he thinks that it's really a question of the macro is not broken, but based on what China does, we could be going into recession. If China does policies which are good for the supply chain inflation case, hey, you actually might have a continuation of the bull market. But if they continue some of their policies and they lengthen the supply chain issue, they lengthen the inflation issues, we might morph into a recession. So in this case, I want to say that there is uncertainty now. I'm going to put 2 question marks. Okay. We also updated some stocks, by the way. So we took out Click, because Click, even though it was at good value and it was doing a share buyback, it's one of the few companies that were supporting the tech industry, the chip industry, that were doing share buybacks. We took it out because it's still sensitive to supply chain cycles, etc., etc. And we put in a new one, Valuetronics, which I think now, okay, especially now compared to then, right? Now it seems to me that it's the most how do I say, cheap compared to the rest of the stuff out there. And we'll talk about this later on. Okay, so let's talk about guidance now. Okay, so remember we did say that here is where we at, just to remind you, okay, that we mentioned this was the first zone for accumulation, and well, sure enough, I mean, and I guess we're lucky in that sense again, for the 10th time now, that yes, we had your 7% bounce because of that. Okay, all right. Now, so if you ask me now, okay, so now as I mentioned, right, it's hard to say whether we're going to go to new highs or whether there's a bear market. Okay, I'm going to be honest with you. It's really hard to say now. But I'll give you the most probable instance based on my experience as a market analyst and someone that's been guiding on the S&P for the last 10 years. Here's one thing I will say for sure, or rather highly likely. Whenever you have one good week, okay, so this is finally we had our first good week, right? Usually a first good week will have a second good week or a third good week. So even though we could morph into a recession, we're not there yet. Based on the information that we have now, I will say that the probability of having at least 1 or 2 weeks of support is high. So you could play some cheap stocks during that time. Okay, so let's talk about where we are right now in terms of certain measures of sentiment. So here's where the probabilities come in. So back just 1 week ago, right? 1 week ago, so this is a chart of what we call smart money in blue versus dumb money in brown. Okay, I don't want to go into how this index is measured. This is from sentitrader.com. But to me, this is one of the much better sentiment indicators, like much better by far. Okay, and so back 1 week ago, smart money was up here. Anything above 0.7 is considered optimistic. Anything below 0.3 is called pessimistic. So at this point, smart money was actually quite optimistic, and dumb money was very pessimistic. Now, the spread or the distance between them, right? The character of it was so similar, almost to COVID crisis, but not exactly. So COVID crisis, yes, the pessimism at the bottom here was as high as it was here, but the smart money was not as high. So that's why I was like, man, it's so good, but not as good as COVID crash. But I said one thing for sure, if the price did come further down to 3540 to 350, 3500, this is probably going to go as high as COVID crash. And that's why I said that that's the other region, which is going to be fantastic. But even then, if you compare to history, look at the major corrections here. So here's a major correction here, right? So this is considered a major correction, but not quite a bear market, right? And you can see that the spread was the same. So how do you interpret this? What you can say is, over here, the market is so oversold based on the fundamental value knowledge of the economy. It was the same value you got in at the bottom of a major correction in a bull market. So in other words, if it turns out that we are still in a bull market, this is essentially your 90th percentile of getting in at the very best time. That means if you bought here and it turns out that we are still in a bull market, you have literally bought in at the absolute cheapest price. The only time you'll be wrong is if we are really in a bear market, like for example, the COVID crash. If you are really in a bear market, yes, then guess what? You have a small bounce, probably, and then it goes on again. But even if it goes on again, right? The point is that getting it at this point here is considered still a good time to get in. I mean, you could have gotten in anytime before that, right? But this is like a very good time already. So let me repeat that again. Based on this sentiment indicator, if it turns out we are still in a bull market, and we are only in a major correction, this is probably the 90th percent best time to get in. Okay. Only if we're in a bear market, then maybe we'll take down further lows. Okay. Let's look at other indicators. So let me explain this about this one. These indicators you see here, these are correlations and not causation. I just want to make it clear to you. It is not that this happens, that's why the market's going to go up. But all these ways I'm measuring the market are ways of looking at how the market behaves in a much deeper manner. So what is this? This is the NASDAQ high-low ratio. So what it does is that this indicator here basically measures the ratio between stocks, right, that are higher versus lower than the one of the moving averages. I forget which one it was. I think it's the 200-day moving average. Okay, it just measures that. And essentially, right, the lower you are means that 100 period moving average. Yeah, okay. So this tells you how many stocks are higher and lower than the 100-day moving average. And it so happens that when you look at the pattern, although the sample size is small, I know you can't really see it, but this is like 1990 to now. The times that the high-low ratio was so low are here. And each one corresponds to a bottom. If you're in a bull market, it's a bottom. If you're in a bear market, at the very least, you have a deceleration. So this was a good time to get in. This was a good time to get in. Here was a semi-good time to get in. Over here, the two times to get in were the last half of it here, which was the best time to get in, but also the first half of this bearish market here. So it was premature here. So that's why now it's when you buy it at this point in time, if you're in a bull market, you got in a really great time. The only time that you might lose some money in the next 6 months to a year is, say, if you were in the middle of a bear market. But still, if you don't know whether you're in a bull or bear, you still sort of have to try. You have to use a poker mentality. Okay. The next indicator that sort of corresponds that is this one, which measures QQQ breadth. QQQ is actually the ETF for the NASDAQ as well. This just tells you the percentage of stocks which are above the 200-day average. Okay, so it tells you how many stocks in the NASDAQ are actually above the 200-day average. And as you can see at the bottom here, right? I mean, here is basically when only 10% of the stocks are above 200-day average. So 90% are below. So it turns out that when that happens, and these are the time it happens, you have the same phenomenon where if you're in a bull market, it's really fantastic time to buy in. You are getting it really at those like absolute dips. Only if you're in a bear market like here, you can be premature. Okay, so same phenomenon. All right, so how to measure this bounce? Okay, I'm going to just show you, right, based on experience, right? And I can't go into great detail as to why to look at these zones alone, because it's actually much more than basic technical analysis. Basic technical analysis talks about resistance, support, and things like that, and drawing lines across here. Actually, I don't do that because my analysis is based on what I understand of the industry. So I'm going to just tell you that these are the zones that you should look out for. Okay, right now the market is in no man's land. The zones that you should look out for will be here and here. Okay. So now I mentioned already that here we were in the first probable buy zone. Okay. Now that we've had the first good week, honestly, there's a 90% chance price is going to get to here, because that's the way the markets work. there are certain levels that are like magnets. They are just attract the price, and only until the price gets there will there be severe market action. Especially today, since we know that majority of trades in the market today are based on quant and algo funds. And I can tell you, because I did some quant work, right, that these levels will be the levels that the quant funds are going to react in. Okay, so basically, if you want to know the brief reason why I think this line and this point is significant is because of it's a major mean reversion zone for algos. Okay, but it also so happens to be so basically what I'm saying is that why I thought that the 37 to 3900 zone was the first buy zone is because I knew there'll be quite a lot of algos that will do a mean reversion here to push it back to the blue line at this point in time. So especially so when there is no obvious recession indicators, obviously if some crisis happens like COVID or something, then it doesn't matter. But in the case where the news is the same, there is no change of news, then the algos are going to work their magic. And so here's the point zone of mean reversion, but it also so happens to be the price projection of a broken head and shoulders pattern as well. So now you have two particular groups of traders they're probably going to try buying over here. That's why I felt that this was the first buy zone. Okay, so it's going to get here. Okay, now if it ever comes here, this will be your second buy zone, because this is on a statistical line here, this red line here, that is super strong support. So trust me when I say that this line here is strong support and usually always holds up so long as there is no full-blown recession. So see, so you notice here, boom, right? It happens a few times before this as well. It's just that here we had the COVID crash, right? And that was a full-blown recession, right? I mean, the world shut down, right? So if you don't get something like that, then this is likely to hold. This will be your next super buy point over here. So this is 1 point, this is 1 point. Okay. So now, so there is a bull price target and major resistance. That's 4,300 and 4,400. So I expect the price to actually get to 3,300 and 4,400. Now, here's the thing. If I believe that if there are some policies, by that time, when it gets there, if there are policies conducive to extend the bull market, so let's say China decides to not shut down anymore and they continue like lowering the interest rates, for example, then I think it's possible for the price to get above. Now, if we get above, right, we are decisively bullish, and you're most likely going to get to highs. Okay, but by the time it gets here, if let's say the supply chain issue gets worse, inflation gets worse, then it's possible to drift lower back to this zone over here. So in other words, I can have a macro agnostic reactive strategy. So let's say today, I'm not sure where we are at. We could have a recovery of the bull market. We could morph into a bear market. So let's say I'm not sure. So one strategy to do is, okay, I mean, of course, if you're super long-term and conservative, you can just exit, right? But if you just want to try to trade, well, you could do something like this. Let the S&P is most likely going to get to the blue line. It's most likely going to get there. So you could just play that. When it gets there, if the price can overwhelmingly get above that, stay in the trade. If it starts to bounce badly, then it's possible, especially if the global policies are conducive to a recession, it's possible to get all the way down here. So that's what I would do. Hold it till here. If it goes above, you can continue investing. If it drops here, you can hold off and wait for it to get to a zone which is much more appropriate. The next powerful zone will be here. But of course, for me, I'll be measuring the market all the way. So along the way, if there's what I find big potential bottoms, I'll probably talk about that. Okay, so since there's a possibility of hitting here and going up and hitting here and going down, well, there are some stocks which I find can mitigate the risks and will be just as what I mentioned before. You can choose some stocks, right, that might still do much better even during a recessionary / uncertain environment. We're going to talk about that at the very end of the presentation. So now, okay, I'm going to turn it over to Joshua, who is going to talk about the macro. So Joshua, would you like to come online? Joshua, you're muted, by the way.
I'm going to unmute.
There we go. Okay.
Hi, everybody. Okay, cool. Thanks. Thanks, Ken, for that. So let's just go through what we talked about the last time we talked. That was the 21st of March. We were saying that forward-looking indicators like new orders of capital goods, durables, manufacturers, housing starts were decelerating, but still growing above average, right? But we had a little worry in new home sales. I'm going to elaborate on that later on because actually it has deteriorated. Sales growth is looking solid, but also decelerating. Okay, but from a high level, income was our biggest worry, and was the main reason why we had a 30% recession odds, right? Because it's whenever it turns negative, usually there is a recession. Employment was very strong, right? And there was a very low participation rate. So that means labor supply had a good chance of increasing, which would offset any wage price spiral concerns that the Fed had. And there was exogenous risk, obviously, at the time, which was the war in Ukraine, which was about a month old at that time. Okay, so that's what we talked about last time. Let's see how things have changed. So next slide, please. Okay, so on the production side, it is still the same picture. I think we had a couple more data points and it hasn't really changed the graph that much. As you can see, we are decelerating. If you look on the extreme right, the dark line, 12-month moving average, has peaked out, and the 3-month moving average continues to show a decelerating year on year. But as you can see, the level at which it's decelerating is very high, right? It's coming from a very high point. So there's still quite a lot of juice in there before it could even turn negative year on year. Next slide, please. Next slide. Yeah. Okay, so US housing is where we have the signs of trouble. Okay, if you look at on the top left, building permits, and the top right, housing starts. Decelerating, yes, but also similar to production leading indicator we showed you just now, decelerating at a high level, right? So it looks okay. However, if you look at the bottom slide, so bottom left slide, new home sales, it basically fell by a lot. If you look at the red line, right, which is the new home sale seasonally adjusted annual rate, yeah, it's come down a lot, and that's pulled down the 12-month moving average way low now. And the reason why new home sales is always a good leading indicator is that, when people buy a new house, they usually have to buy a lot of other things that go along with the house, right? You buy furniture, you buy white goods, you buy a whole lot of things, and that keeps the economy going. But here we have it's actually turning negative already, so that's a red flag. And then when you look at the bottom right housing month supply, so if you look at the red line, it's actually above the number 6, right? So it's the right-hand side axis, right? So it's actually above 6 months. So when it usually goes above 6 months, that's when people start to worry. If you look back at the housing crisis of 2009, you can see that it crossed the 6-month line somewhere in the middle of 2006, right? And then that was actually the start of, and you see the red line keeps going higher and higher and higher. That was the start of when people were starting to really get worried about the housing market. And of course, we all know what happened. Okay, so we have it climb above 6 months now. So that means it's a slight oversupply situation. It's kind of happening, right? So this is where we have to take note that not all is looking good in the US economy. Next slide, please. Okay, so demand, this is retail sales excluding petrol. As you can see, it's also still growing, but also decelerating. Next slide, please. Okay, so the labor market looks pretty much the same in terms of capacity. There is quite a bit of spare capacity. So the purple line is participation rate, which is very low, below pre-COVID levels. Okay, so if that trends back up to 63%, that's actually a major boost for the economy, right? So lots of people will be working, there'll be lots of spending, absolute income levels will be rising. However, real wages are pretty low right now. So if you look at the bottom graph, the red line, real disposable income, is very negative. So we pointed this out last time, and that was our chief worry. So not much has changed then, because inflation has not come off at all. So even though there is some nominal income growth, it gets completely eaten up, right? And there is also some negative, well, not saying, also some high base effects, because at this time last year, there was a lot of government checks being handed out to people, so incomes kind of skyrocketed. So compared to last year, there was always going to be poor base effects, right? Because you're comparing to a very high level last year, and those payouts have disappeared, right? But nonetheless, because of inflation, it has gone negative, and that's our worry, right? Next slide, please. Okay, so inflation. I thought instead of just showing you the CPI, which is doesn't tell you that much about what's going on in the future, because CPI is about 1 or 2 months late usually. If you look at the top left chart, that is industrial metals. Okay, so industrial metals have kind of peaked out, bouncing off the 40-week. These are weekly 5-year charts, right? So industrial metals have peaked out. And then if you look, and then the top right chart is battery metals. Okay, so battery metals also have kind of topped out. So those two indicate to me that there's some kind of demand problem in the economy, because industrial metals is is something that's needed by industries. So manufacturing industries, if their demand is starting to wane, this kind of chart might be quite telling. And the same goes for battery metals. Okay, so the bottom left one is energy, right? So you can see that although there was a very euphoric peak there because of the war in Ukraine, we're still trading into that rejection zone, right? And because we keep trading into it, it tells me that maybe this thing could still go higher, right? So we're having sticky energy, and on the bottom right, we're having sticky food, right? So food prices are trending higher. And the food prices problem is, I suppose, a direct result of the war in Ukraine. A lot of food can't get exported, so it's going to create problems all over the world. And that's a risk that will be felt everywhere. And for energy, energy usually peaks out right at the very end, because it's quite an inelastic demanded commodity, right? People drive anyway, whether in good times and bad times, and you only really see crude prices drop off, right, when the recession really starts to hit. So at this point in time, it's looking like it'll still inflict some pain on consumers. So I think what I really want to say here is that the fact that battery metals, industrial metals have peaked out is indicating a demand problem, and we are going to have, but we are still going to have inflation because of energy and food. Next slide, please. Okay, Europe is. I don't have a lot of granular data in Europe like I do on the US. So, I'm going to look at the PMIs here. The PMIs are are coincident in the indexes. So they don't actually give you a lot of forward-looking readout, but they're pretty good telling you what's happening right now. Okay, so on the right-hand side is manufacturing PMI is at about 55, which is way above the 50 zone. So 50 is where you have to, if you go below 50, it's a contraction. If above 50 is an acceleration. Okay, so actually we are still expanding at a healthy clip, right? Even though, you know, we've come off the highs. And then for the composite index on the left, that's made up of services and manufacturing, but services is like 85 to 90%. Okay, so it basically is telling you that the service economy is buoying the overall index, because you can see that it's still kind of rising. Next slide. Okay, so China had a shock, is now in shock recession. It's not going to come out in the GDP numbers yet, but it'll probably come out in the release for the March to June quarter, right? So here you see the services has like completely cratered to about almost 35, which is way contraction. Manufacturing, just as bad, right? 50 has cratered down to 45, near 45. So, you know, Chinese economy, because of the COVID curbs, went into a shock recession in April. Right, so next slide, please. Okay, so let's summarize, right? So the forward-looking indicators, new orders still at a high level, but housing has soured, right? As our previous worry on new home sales has come to pass, okay? And peaked out metals also indicate that demand is waning. Real personal income, our biggest worry, continues to remain negative as inflation continues to impact. And then now we have a food shock. Employment, very strong. Biggest plus is that participation rate is low and climbing. And this means the supply of labor will increase. So this is probably one of the few good things to remark about the economy, the US economy. So Eurozone, remarkably resilient. We're entering holiday season, and from what I can see, lots of Europeans are rushing for holidays all over Europe. So, you know, they haven't had a good one for a long time. So that may continue to buoy Europe, actually. However, the main problem right now I see is China, which is in a shock recession, right? So China being in recession is a huge downside risk, right? We have Europe and the US still expanding, but decelerating, right? And then now you have this shock recession from China. And you still have inflation, right? It may have only mildly peaked because, you know, you still have crude and food, which is going to keep things high on the inflationary front. So this means central banks will continue to be on a rate hiking cycle, and they're hiking into a deceleration, right? They're not hiking into strength, they're hiking into weakness, right? They're hiking into growth weakness. So that's also not a very good thing. And you combine that with what's happening in China. So my feel right now is that, you know, I think we have to raise recession odds from 30 to, I put 51, because you know, I was going to say, oh, it's maybe even, right? But I would say it's probably more than even, just slightly more than even, that we might have a recession. So I put it at 51. So what could flip things around? Well, hopefully China reverses the COVID curves, but they don't have a good vaccine. So it's likely that they will persist with the COVID zero strategy and the lockdown stress strategy, which will, you know, produce a stop-start muddle-through economy. So yeah, things don't look too good on that front. Recently, they have been relaxing, but like I said, you know, it's going to be stop-start because you need a good vaccine, right? And they don't have a good vaccine. So every time there's a flare-up, it's quite likely they will go for COVID zero again, and then there'll be another lockdown. So who knows how many times there'll be like relaxing and locking and relaxing and locking. So, you know, every time they relax, of course, economy does better. And then when they clamp down, economy does worse. That's why I say it's, you know, I'm not prepared to say that recession is like 60, 70%. But you know, it's going to be like a stop start, right? So there's going to be positives and negatives there. And so I've got it at 51, right? So fundamentals to me suggest that this rally might be sold into by investors. So looking at what Ken was talking about, I think you put 45% as a sell into this rally, right? And maybe going towards the 200-week moving average, I think I recall. So this kind of gels into that. And yeah, I think, do I have another slide? No, I think that's it.
Yeah.
Yeah.
So right now, right? Thanks, Joshua. That was a really good recap for the macro. Thanks for the insight. So now, okay, we're gonna do some value addedness, and we want to suggest a couple of stocks, right, where we just find that the reward to risk going into the next season might still be positive. And so before you leave, Joshua, maybe let's talk about your stock idea first before we come to mine. Okay, so I'll go to the slide. I'll give you a second. Okay, so
yeah. Okay, so this is my idea, which is what I talked about on the 21st of March. Yeah, so, you know, I think it's got a nice uptrend. So what's behind this uptrend is that actually in times of economic weakness and in the tail end of bull markets, maybe the beginning of bear markets, actually, and also in inflationary periods, real estate tends to perform quite well, especially REITs, right? And the reason is because they have resilient revenues and cash flows. So CapitaLand is it's a fund management business now. It's no longer a property developer, it's a fund manager. Okay, so that's a key distinction you have to realize. So what do fund managers do? They have assets under their management, funds under management, and they collect fees on that. Now, so the thing to know about an entity like CapitaLand Invest is that their funds under management is gonna consist of private equity funds and REITs, right? So the private equity funds will be managing third-party money, so mainly not their money, but they may have a small percentage in a fund, and the big percentages of the fund would be other institutional investors, pension funds, sovereign wealth funds, stuff like that, okay? Insurance companies. And so these funds tend to have very long gestation periods, 10 years, maybe 5 to 10 years to develop assets. So basically it will manage that pool of money, right? And it will collect fees on that, and it will collect bonus fees when projects are finished and the assets are sold off, right? And so whether the economy does well or does badly, it's still going to collect fees on whatever assets it has under management already, right? And so it's new, so very few funds would be closing, right? Most funds would have probably just started their gestation period. So the downside risks of funds closing and having to raise new funds is lower now. So with that, they are going to be looking to grow their assets under management from 86 billion to 100 billion. And then for the REITs, which are charging rent, usually in a downturn, rent is the last thing that gets cut, right? The first thing that gets cut is advertising. The last thing that gets cut is rent, because when you cut rent, basically you close shop, right? So unless we have something very severe and lots of businesses going bust, then they'll still be collecting rent. Okay, so it's in line with what Ken was talking about. We want something with a cheap valuation. So It's got a very cheap valuation of 1.2 times book value. So the two global peers are BlackRock and Brookfield, who have way higher valuations, right? You want something cheap, you want something with resilient revenues and cash flows. So like I explained, that is the case from CapitaLand. And you will also, there's the bonus of being an inflation play, right? Because it's real estate. So yeah, this is one that I feel that is pretty safe and comfortable to recommend in this sort of environment.
Okay, thanks, Joshua. All right, let me get my camera on. Okay, so now I'm gonna suggest you a couple of more stock ideas that might still do reasonably, will still outperform the market going forward. So the stocks I'm going to show you at the moment will more or less fill this characteristic, okay? So knowing that we might go into some sort of recession going forward, there might be some volatility, we definitely want to look at stocks, right, that have, that have these characteristics here, okay? So I'm choosing those that have cheap valuation, they must have strong cash flow, okay? And those cash flows should be ready to flow directly to investors, okay? We're going to select some which I think is somewhat defensive in the sense that they might not be overly affected as the macro deteriorates, or they could be in favored sectors. So here are the ones I'm going to talk about: ET, VST, Crocs, Electronics, CML, and X. You'll see why in a moment, why I still feel that these have a chance to either still creep higher, even if we go into uncertain environment, or even if it goes down, it probably will not go down as much, okay? They all should have reasonable debts, or at least be close to their debt targets. And they should be making at least roughly 8 times cash flow or more in this year and next year. In other words, they already have established some sort of guidance. So generally, these stocks will fill these conditions. So the first one is ET. So ET was the one we talked about right at the beginning of the year. So right when the price was over here, we already said that this is probably going to go up, even if we go into some sort of recession. Okay, can it still go up? And the answer is yes. Okay, why? Because at the moment, here's what's going on. So it's at 7 times forward PE. Now, it's at a debt level of 4 times net debt to EBITDA. This is high, but it's actually at their target debt levels. ET is a midstream oil company. So because it's a midstream means that they charge a fixed fee, more or less 80% of their revenues come from fixed fees, just by charging people to use their oil pipelines. So in other words, right, their earnings is actually not directly proportional to oil prices. That's what the oil producers are like. This company actually, when the price is high, oil price is high, the price of oil is low, actually the difference can just be just 10% difference of earnings, because 80% of their revenues are fixed fees. Okay, so because of that, you can basically make a prediction that, hey, the cash flow this year, next year, you have it's much easier to estimate what those earnings will be. Okay, and so here, just to give you an idea of how cheap it is, this quarter alone, they managed to hit 2.1 billion distributable cash flow. Distributable cash flow means that, after, this is how much money they have after all their capex and after all their expenses and everything. In theory, they could actually give this much back to shareholders. So that's in quarter 1 versus 35 billion market cap. So if this is in quarter 1, just multiply this by 4, the run rate is 8 billion. So 8 out of 35, right? I mean, what is that? That is 20% cash flow yield. So just think about that, okay? So yes, could we go into recession next 6 months, next 1 year? Could the index go lower? Yes, but this can give you a potential of 20% cash flow yield if they give up all their cash to the investors. So I still think that there'll be a lot of value investors that will still think that this is worth something, even during that time, okay? And also, now, I actually did a presentation on energy transfer. So if you go back I think 1 month or 1.5 months ago, I gave the story to show you that earnings might still even grow further because they actually have some projects coming online soon. So you might have a single-digit growth to earnings, inclusive of the 20% distributable cash flow yield. So that's actually pretty good. So that's why I say for this one, I think you will accumulate on pullbacks. I don't see this stock cycling. In other words, what I mean by cycling, like having a giant drop, a giant cycle drop. Most likely, if it drops by 5-6% because the market is jittery, it'll probably get bought up again because of the strength of its cash flows. Also, ET is in a position where they already said that because they hit their debt levels, they're willing to either increase the dividend rate or they're willing to do share buybacks. So the point is that they are in position to reward you guys with this cash flow. And that's the reason why I don't think it will cycle. I think that if this gets sold off because of broad market concerns, at a certain point, it'll get bought up again. So that's one. The next one we talked about is Vistra. Vistra is a utility. And so the good thing about utility is that whether you're in recession or not, everyone is still going to be using electricity. And if you believe in the EV boom, for example, if you believe that, and if you believe that more and more there's going to be more electric vehicles, then you expect electricity usage to increase. So anyway, same thing here. Vistra has very visible earnings. In fact, when I do a study on their company, it turns out 80% of their earnings are visible 1 year out. Because this company does a lot of contract stuff, they can actually estimate what their earnings are to 90% 1 year out and 80% 2 years out and 70% 3 years out. So because of that, you once again have more visible earnings, right? So what is the valuation now? They just recently reaffirmed their guidance that their free cash flow before growth, okay, is 2.1 to 2.5 billion versus its market cap right now of 11.3. So even though we know that since the beginning of the year, it has gone up by 12%-ish, can it still go up? Yes, because it still is around 20% cash flow yield. And second of all, they have already, their plan, which they've already guided, is that they're going to continually to buy back shares every year for the next 3-4 years. So they've already purchased $850 million of their $2 billion share buyback plan. But actually, next year and the year after, they plan to do at least a $1 billion share buyback plan. So in other words, that in the next 4 years, right, they're trying to buy 40% of their own shares. So in other words, all of the cash flow you're getting here is sort of going directly to reward the shareholders in that sense. That's why I think same thing. When you go into a recessionary environment when people are uncertain, investors, if the investor wants to invest in something, they will always go to companies that has some sort of predictable cash flow and at cheap valuation. And I think this is also one of those plays. One bonus, which I think that the market has, because this company is not covered that well. One thing, there's a catalyst even going forward. So this is their guidance, which they mentioned, I think 2 months ago, 1 month ago, 2 months ago. There is a bonus because they recently announced that because natural gas price exploded, right? So because of the favorable forward curves of natural gas, and by the way, Vistra is, as a business entity, right, is actually net long natural gas. That's what people don't realize because they actually own natural gas assets. So because of this good forward curves, right, they actually decided to hedge and lock in the prices. And because they locked in those prices, it means that actually they expect even more earnings because of how they locked it in. So once again, I think this stock will be very similar to ET in a sense that, yes, can it drop because of broad market fears? Yes. But at a certain point, Vistra is going to buy back its own stock. And that's why I think that it's going to continually go up, even though you might have temporary 3-4% drops. So Vistra will be one that you accumulate on buyback, pullback as well, knowing that their business model is not going to be as affected by what's going on in the global markets. Vistra is a utility in the US, by the way. Okay, next. Valuetronics. I've written two recent blogs on this. Here's where I disagree with the analysts that are reporting on Valuetronics. So the analysts who have been reporting on Valuetronics, right, they have been, they don't like the fact that margins are eroding and the story of supply chain and global component shortage issues continually is going to affect Valuetronics. So because of these things, they all put a hold recommendation of Valuetronics. They're not willing to say buy yet. But for me, right, as a long-term investor, and by the way, I'm the sort of like the original Valuetronics analyst. I was the one that actually first started recovering them in 2014. So I actually disagree, because the thing is, yes, is the story on Valuetronics such that it's not obvious, meaning that, you know, you get a surge and it keeps going up? It's not there yet. However, at a certain point, you have to say it is too cheap. The margin of safety is too high, and my downside is so low that, especially going into a bearish market, remember, the next 6 months, right? Companies that are at full price discovery going into an uncertain market will probably get hit quite a lot. But Valuetronics has a really large margin of safety. So the not so good thing is that the headlines look iffy. All right, we know that. But here's where I'm willing to put a bet in. One, the Vietnam expansion is fully operational. This is what they've been trying to do for the last 2 years. It's finally operational, which means now they can be aggressive in finding US clients, which had made them very successful in the past. And sure enough, they've already announced they've got 3 new industrial clients, okay, that's going to go into mass production this year, like now, starting already. So in other words, you're going to have 3 new clients out of present 8, which means that in theory, you could get a 20-25% boost in this segment just based on the new clients alone. So you have this positive uncertainty. Okay. Now, next, right, you have to think to yourself 2 years, 3 years later. In 2-3 years later, right, margins are going to normalize. Margins are going to normalize, you know. So whatever hit you have now is quite temporary. So what do you have now? Okay. Based on the last half that just passed, and they just released their results last week. Okay. Just based on this particular week half, we are already at 12 times PE if you assume a run rate based on this half. Okay, that means with margins already impacted, it's already at 12 times PE. Now, here's the thing. All these years, because Valuetronics has never had a negative EPS year. They've always made positive earnings, even during the worst of times. That's why I like them. And each time, they take the cash flow, they give out 30-50% of dividends out, okay? And then the rest of it, they basically keep it, okay? And when they keep it, they've been increasing their cash hoard. So actually, Valuetronics has a lot of net cash. It has so much net cash that 70% of their market cap is based out of net cash, which means if you take out that cash, right, and you just do what is the PE, assuming that you take out this net cash, in a way, this is an enterprise value to earnings, it is 3.5 times. So it is 12 times PE now, reasonable, but 3.5 times PE x cash. To me, this is so cheap that I think that if you're a long-term investor, your probability of losing money is very, very, very slim. Okay, can the price lag here for quite a while? Sure. But since we are saying 6 months later, we could have a recession, right? I want to go into stuff that has a very large margin of safety. This is one of them. And you have a super safe dividend of 4%, and that's likely to increase over time. Okay. And here's the kicker. I don't know why the analysts, as I read the most recent 2 of them, they didn't put any attention on this, because they've already come to a point that they are using their net cash finally. How do I know? Because they have implemented a share buyback of 250 million Hong Kong dollars. How much is that? 43 million Singapore dollars. What is their market cap? 220. If they buy back $43 million of their own stock, that's almost 20% of their stock. That is hefty. So what does that mean? Even if the sellers, even if there's a buying strike on Valuetronics, people are hesitant to buy it, they will buy themselves, and they can buy 20% of it. And not only that, so I'm just going to give you some potentialities. Okay, so let's say next half, right? So let's say margins are still impacted and earnings drop a little bit more. Okay, let's assume that. What will this look like 2-3 years later? Okay, I'll paint a picture for you. Remember, now it's 12 times PE. 2-3 years later, one, they're going to have 3 new ICE clients, and they're probably going to get 1 or 2 more. Okay, historically, they've always been able to do that. Just based on that alone, earnings will increase 20-25%. That's one. Second, 3 years later, margins are going to normalize. If margins normalize, you're going to get another 20% boost. That's 50% increase 3 years from now. Finally, they're buying back 20% of their stocks. So in other words, earnings per share will increase by 20% just based on this alone. So 3 years from now, worst case scenario, the recovery takes 3 years. Worst case scenario, you're going to get a 12 times PE now, which will likely increase by 20, 30, 20, 75% in 2-3 years time. So to me, it's like the risk rewards in your favor if you're a long-term investor. And because it's such a net cash company, right? To me, the way I look at this company, if you buy this, I look at it like it's a fixed deposit that has equity upside potential. That's how I look at it now. Okay, so that's Valuetronics. Check out my blog posts if you want to read more about it. And finally, 3 more I just want to add to, just add to your plate to look at. All right, maybe not so fantastic as what I just talked about, but still worth looking at. Crocs, okay, 5 times PE, forward PE. Okay, earnings have been growing in the last 2 years, organically and inorganically. The only downside to this is that because they just recently acquired this shoe company called Hey Dude, their debt limits, the debt levels are at 3 times, but they want to get it to less than 2 times by 2023. So they said, they already guided that they're going to spend this year to pay down debt. And once they finish doing that, they will reward the rest of the excess cash to the investors. And this particular stock has some insider buying. So this one is like quite good, not so good. I would much prefer if they were already in a position where they can do share buybacks, but they will get there by the mid of next year, okay? So this is something you should just put on your radar, knowing that the story in which they're going to reward you with good cash flow is coming, okay? Next, Cumulus Media. This one, same thing, okay? It's radio programming. It has 5 times cash flow. It already hit their debt targets and is about to initiate a 20% market cap share buyback. They're going to start this next quarter already. Recently, they already had a takeout offer at $15 to $17, which they rejected. The price of this company now is $11.50. So this tells me there is definitely potential catalyst for the price to go up despite whatever the economy is doing. One, they might have a takeout offer, which is $17 or more, which they might accept. It proves that people are willing to buy this company, right? So this one. Second, they will be buying back their shares, which will give support to the share prices. The only good thing about it is that for some reason, there's no insider buying. So boo. All right. So I think these two are worth putting on your radar. And if you feel like there's a proportion of your portfolio that you want to buy something, right? These are potentials. Finally, there's US Steel. I want to say this is cyclical. Okay, so this one might give you a heart attack. Okay, but here's the story. Of course, US Steel, because steel prices went high, it made mega bucks, super mega bucks. Okay. So how mega bucks? Just this year's earnings, forward earnings is going to be 2 times forward PE. That's crazy. Of course, steel price is expected to drop, right? We know that. That's okay. But the thing is, but based on what the earnings are going to be projected 2 years from now, it drops from 2 times PE to 11 times PE. To me, that's still acceptable. And of course, 2023 is 6 times. So although you do have the sort of like a bearish connotation that, earnings are going to drop significantly, but the thing is, because the megabucks is so high, even if it drops, it's still reasonable, okay? They already said they paid down almost all of their debt. That's the thing. Last year, because there was so much megabucks, they paid down their debt such that they are less than 1 times debt to EBITDA already, less than 1 time. And they already mentioned that starting this coming quarter, they'll be returning capital to investors. So this company is in a position where they're going to use their financial flexibility to basically reward investors. Okay, but then at the same time, this one doesn't have insider buying, so boo. Okay, so that's not I wish they did, but it didn't have it. So anyway, but this one is sort of cyclical. And because so much money is involved, the fluctuation is so big, like from 2 times to 11 times, you probably don't want to be a long-term holder, but this has the potential to actually spike. It really does, especially when next quarter happens and they start to actually return money to the shareholders. So why do I mention these? Because as you notice, right, all these things that you have, ET, VST, Valuetronics, Crocs, Cumulus, US Steel, all of them have business models that are not quite correlated to the global component shortage, etc., etc. They all have cash flow levels which are quite high, and they're all willing or close to or at a position where they're going to buy back their own stocks. So these have a chance, at least there's a chance that the price can still crawl higher even if the broad markets crawl lower, because they can buy back their own stocks. So these are the reasons why I mentioned these things. Okay, so Joshua talked about the Kaplan Invest. Okay, so if you want to know, of course, in this presentation, we can only talk to you for an hour plus max, right? So a lot of the things we talked about, whether it's stock picking, how do we find these stocks? How do I measure those bottoms before those stock market bottoms happen? We are offering classes now to teach you these things. So if you're interested in those classes, whether it is technical analysis, fundamental, and we do have a class coming, or we are in development of it, please drop us an email if you're interested. Now, I just want to preface that we are not offering you just like basic technical analysis or basic fundamental analysis. These things are easy. In our course, we have videos that you can watch, right? So we give you the basic technical analysis videos to watch. We give you the intermediate technical analysis videos to watch. But then, well, at least for myself, I'll give you at least 6 to 8 hours of my own private time to teach you all the nuances of how to use it, and also all the techniques that are not covered in the basic and intermediate. So even though if you see the course basic technical analysis, you're not really paying for that, because that can be found in just a book you can read. What you're going to get actually is time with me, and how the basic technical analyst can sometimes get it wrong, and how you can overlay it with macro fundamentals and sentiment to get a much higher probability of finding bottoms and things like that. So yeah, so if you're interested, please drop us an email. Finally, this is a ministry. I hope that you appreciate that we sold all this knowledge to you, and that if you want to help keep the lights on, if you want to sow back in us, then please send your contributions, gifts, or tithes to here. International clients can use PayPal, but if you're in Singapore, here's the PayNow details. And of course, send us a message on QuantZombie.com if you're interested in classes, trainings, or if you just want to thank us for what we're doing. All right, so that concludes our presentation portion. Okay, I'm going to stop recording now.